So this is going to be a trade breakdown for the trade that I posted into the mentorship channel. So let's break it down, and I want to break down the specific management. We'll talk about the setup, what the setup is, in the weekly report. We'll go over more in depth the reason for this, right? So here, I don't have midnight opening price on this screen, right? If you see the screen that I have here is pretty naked, it just has this, and this is for the reference for the video for you guys. On the other screen, I'll have midnight opening price, which I do put on later on this screen, and you'll see when we get there, I'll pause and I'll speak about that. This is a daily rejection block on the Euro USD, and it's Wednesday, and I was favoring a midweek reversal, right? So let's go on to the trade, right? So from here, right? See that run on stops? Now, when we see this, yeah, you see this candle? It didn't do that. This candle, it didn't run that previous candle's high. That candle ran the previous candle's high, comes down lower. I'm expecting a open, high, low, close delivery, right? And that's on the 1 hour. So I'm expecting this candle to trade down lower, and that's gonna open up what for me? That's gonna open up, scalps in line with the hourly candle's direction. Notice the time is 10 minutes into this candle. In the first 10 minutes, we went and made a high, and now we're moving down lower. Think about you have to kind of compare the times for candles opens, right? On the daily, we expect the opposing end of the range to be made within the first 3-4 hours from midnight. Likewise, we expect them to be made early on, right? Within the first quarter of that candle's lifetime, we want to see the opposing end of the range usually be made if it's a normal protraction. Delayed protraction, it could be, 50% of that candle or even later, right? So just consider that. Now, what I did here, if I just go back a bit, premium, right? We're moving back into a premium. Now, this is a simple model. Market structure shift into a high time frame PDO rate. This means nothing. You see this run on stops, breakdown lower, it means nothing, right? Now, one thing I want you guys to be aware of is this. You see on this time frame, right? On this time frame, this is the 5 minute. You see this run lower. It can catch a lot of people out. Now, you have to evaluate as a trader is this. You see this low here. Is the run beneath that an institutional order flow entry drill? If that is, be careful and wait for confirmation on entering because that could just be a run on sell stops into the fair value gap to move higher. When there is no fair value gap present under this low and you get that market structure shift, that's a good level of confirmation to look for. Now, what am I doing here, right? I'm expecting from here. Now, listen to this. We made a high and we made a low. Now, when we retrace up, we expect there to be another high, right? And then to make a low low. Now we expect there to be, lower highs, lower lows, lower highs, lower lows, right? Simple stuff. What I want you guys to focus on, and the higher level people, the guys that have been with me for some time, I want you guys to nail this. Without the previous candles forming, right? And this is how I view this in real time. We're in the premium of the range right now, clearly offering sell side delivery. We're looking for where the next possible high on this time frame is going to be made. And then when that high is made, I'm trying to get as close as possible to that high and target a level of sell side liquidity being this low. Does this look like it's a rejection block? Previous candle sweep, and you see how we displaced down and broke that candle's low? Where do you think the next candles are going to do? This is probably going to be the start of a range. Remember, how does the PDO matrix go from the top to the bottom? Rejection block, order block, fair value gap, right? Mitigation block, order block, rejection block. Do you see it? In saying that, I'm anticipating that this is the start of a range. So if I can get in, I can probably ride down to the discount and try and get down to this low. And you'll see how we monitor the trade around this area here, right? And what I said with the PDO matrix, you're going to see I say a specific text where I say I want to see a fast rally down here. And when we get there, I'll remember what I said. The hint is this. What do we expect? in 50% of the PDRA matrix, right? So let's just play the video. So what I'm doing here is this, right? Now, I want to enter here because it's going to be one of two things. It's either the next candle, right, is going to create a fair value gap. This candle's going to close and it's going to create a fair value gap, and I want to get that institutional order for entry drill into there and move away. Or this candle is going to create no fair value gap for price to retrade into here and move away, and I'll get wicked in anyway. So that's the methodology behind that, and it's all in line with the open high low close delivery. Now the DXY, right? Of course, we're matching the DXY with it. From here, it's just time. It's just literally just time. Now you're gonna see that right there, and you see how it left no fair value gap, right? It left no fair value gap. That candle did not create a fair value gap. But I'm anticipating this, right? Now, okay, back to this candle. I'm expecting sell side delivery. In saying that, you see when I see up candles, I want to sell in those up candles because I'm assuming that when this candle is green, that entry as is green is going to be a wick entry. I want you guys to make a note of this. Is the candle likely to go from green to red? Now, what is green to red? Essentially, it is from bullish to bearish, right? In saying that, it's basically is the candle reversal. Now, in the sell side delivery, up candles, we want to see them go from green to red. What does that mean? We want to see them start off bullish and end bearish. Now, in saying that, it's going to go from red to green. Anywhere in the green, which is anything above the open, should be a wick, right? And that wick entry is what I'm trying to get. So bear in mind, is this candle after this one likely to be a green to red candle because I'm trying to sell into the candle and away, right? Now, what I said here is we're always trying to look to shave off risk. Now, let's let the trade develop. I'm gonna give you guys serious bombs on how to actually manage a trade and a new methodology that I want you guys to adopt. Okay, right here. Now you see, as I typed that, we got the rally. Now, why is that? Why is that? Rejection block, order block. What comes in the middle of the range? Fair value gap. Now, how do you create a fair value gap? You need a rally, you need a displacement. So that's how you can anticipate when there's going to be you know, quite a sharp expansionary move. Run liquidity. Now, this high is very obvious that it's a swing high. Why? Because we retrace back into, right, this old low. We're retracing back into this breaker here, even though we overshot it. And it's premium of the range. We expect if we retrace down here, we expect if there's a retracement offered, the next swing point to be made, premium of this range and then move down lower. That's how you can anticipate that and get in with proper open, high, low, close, theory. Now, here, we are always trying to look to shave off risk. Always. Now, let's talk about that for a second before I play the video. You see this, yeah? This trade right here. Let's say this was a 1% risk. This was a 1% risk. Now, you see how it's going down my way. Now, without taking a partial, I can remove the risk of the trade by reducing the stop loss. Now, what about if I halve that stop loss? Essentially, it's a 0.5% risk now. But if it TPs, that's 2R. That's basically turned into a 4R trade. Now, imagine this comes and stops me out after, right? Let's say I went to 50% here at the rejection block, which I could have, and I was really thinking, should I go 50% into this rejection block? You see how 50% of the stop loss lines up with this rejection block? Because if I get a retracement back into that rejection block, probably it's going to possibly run to my stop loss. So let me just get there because I would want to get out of the trade there, right? In saying that, and I'll take a 0.5% stop loss. Now, if I can manage trades like that all the time on a 1% risk, and I can always manage it pretty well, not always, but a lot of the time I manage it well, where I'm making my losers very small by managing my stop loss efficiently when price is moving in my way. Imagine what happens when you hit a 3R trade. You can make back how many losses? 5? 4? Do you see my point? A lot of people would just accept that full stop loss. Why would you do that? You know your stop loss. Think of it like this, yeah? Every single time price is moving down this green, think about this red extending out here. Price is moving to your stop loss, right? Why would you let it go all the way into your stop loss and eat your profit? Just dwell on that, right? Now that's why do I line out these boxes? In all the videos I do, you see, and always I do this, I line out this because this can enter a pyramided trade, a fair value gap, institutional order flow entry draw into that and move away. I didn't want to put it on, but this here is a reclaimed fair value gap. And you can find, a move anywhere, move into this fair value gap, this candle, or this, I prefer this institutional order flow entry draw in this fair value gap here is another, trade if you didn't get it there. Now that's that rally that we're expecting, right? This is a market maker buy model, right? Initial consolidation, manipulation down, right? Ran the low, that rally there, institutional order flow entry draw around 50% of the range. Yes, it might not be exactly 50%, but this is this fair value gap. If you look at this candle from the low to the high, it's gonna rest in the 50% of the range. Institutional order flow entry draw. After this candle, you can literally get in on a open low high close on the DXY, and you're gonna be targeting this buy side liquidity pool above here. That frames the market maker sell model on the DXY, on the Euro USD, sorry. Okay. Okay, pause. Okay, wait 1 second. Let me. Okay, cool. This opposing order block and rejection block being these two down close candles and the wick being the rejection block, right? It can pose resistance to our run on the low here and the run here, right? So in saying that, it can lead to retracements and it could lead to reversals in the market. This is the thing. You have to be able as a trader, you have to flow. A lot of people, they're just too hard-headed in their approach. In my opinion, this is the better way to do it. It's not fear, it's anticipation. Don't be fearful, oh my God, it's going to reverse here and hit my stop loss. Think about what if it reverses here? I'm in profit. Let me at least minimize my risk on the trade. From this point in this trade here, why on earth would you accept this stop loss and a 1% risk? Remember, my stop loss was up here. What person would want to, at this point in the trade, let price go and take them out 1%? Look how much price has to move to go all the way back there. Why would you do that, right? Always look to shave off risk. Now, the way you want to shave risk off is like this, and we're going to make a video on it, a lesson on it. It's going to be a short lesson. It doesn't need to be long, but it's going to be very in depth on how to do it. But essentially, it's this, and this is the crux of it. Every single time there is a reason for a new invalidation level, look to put your stop loss there, right? For example, there's no fair value gap in here. Do you see how there's no fair value gap in here? This candle's closed it. You can put your stop loss above this high, right? You can put your stop loss, like where I put it. You don't expect price to go back into rebalanced areas. If we go on institutional order for entry draw and we move down, away from it, back to where we are right here, I would put my stop loss at this candle here. Because why would we go in IOFD again? If we get back up there, it's probably going to go reach for the high. So I want to be out there already. But you know what it is? And I'm going to be dead honest. And you guys watching this need to be dead honest with yourself because I know how it is. I was there. I was like you guys watching this video. But then if I get stopped here, I'm making like what, 0.2%? But do you want 0.2% or do you want -1? What do you want? -1%. I would rather, because listen to this, that 0.2%. Let's play, let's do hypothetical situation, right? Let's say in one scenario I took a 1% loss, and in one scenario I took a 0.2% profit from, if I got stopped out in profit here. Now let's say the next trade went and lost 1%. Which one's worse? I'd be down -2% if I didn't manage the risk, the trade, or I'd be down, minus 0.8. Which one's better? Which one do you think over many trades is gonna minimize the risk on your system? This is how you guys got to think of it. Stop thinking trade by trade, right? This is how you got to think about it. 10 trades managing the risk here, you can literally half your net losses. Think about that. And then one winner will mean a lot more to your system. A 2R trade suddenly or 3R trade suddenly becomes, whoa, that holds a lot of weight because I'm managing risks where I go in with a full 1%, and if I win that trade, I'm winning a whole 2%. And if I lose the trade, given that I manage it well when it goes my way, I lose maybe zero point 0.4, zero point 0.3. So then those 2Rs in those managed trades, suddenly they become 4R trades, 6R trades. Do you see the methodology I'm posing to you guys, right? Let's continue the video. Now here, break even, risk free, absolutely risk free. And this is where I look to starting to close out the trade, right? Risk is off the table. Now let me start taking something off. And here you'll start to trade it in profit. You can't see trading in profit in TradingView, right? That red area won't move lower. That rejection block right here, right? You could partial right here, some of it. You could literally take a big partial right there, and there's nothing wrong with that. That's just being cheeky. And we're framing that run on the high, and EU was weaker that day if you're looking at Euro GBP, and that's the run on the low. Now right there, oops, let me go back a bit. Now let's look at this. That's midnight's opening price. If you look at that, where I put that, that's midnight's opening price. You see that run above into the rejection block? Think about the daily candle. Look at the daily candle. The open, yeah, we traded down lower a bit, but do you know what that is? You know that candle, right? How it traded down lower, and then it traded up higher, and then it traded down lower again. Candles do that. You have to understand the daily candle can do that as well. So you have the opening, that candle down, move lower, and then look at this expansion into here. When you see that candle hit into a PD array, that this is the daily candle. Look at it like this. You need to see, and it's kind of hard to explain, but when you're looking at the 5-minute chart using midnight's opening price, you have to envision the daily chart as well. You're seeing two time frames on here when you're using midnight's opening price. By just putting that one midnight opening price, by putting any higher time frame candles open onto your 5-minute chart, you're not only looking at that time frame, you're also looking at the higher time frame as well, because you have the opening of that candle. This is just the anatomy of it, right? Midnight opening price, the daily candle hits into a PD array, and you see now that wick away from the daily on the 5-minute is this market structure shift, right? And the true one, because it's in a higher time frame PD array and that displacement lower. You're then looking to engage, right? Oh, I don't know why I done that. It just went on to like a weekly commentary for some reason. Oh. So here, we move down into it. That's what I want you guys to do. This is you envisioning the daily candle. Be absolutely conscious of the daily candle, right? From where midnight opening price is, yeah, and this is your higher time frame, your narrative, right? This rejection block. Does it make sense for the daily candle to expand from here or to reverse? That's all it is. It's the daily candle expanding or reversing from where midnight opening price is, given if it hit into something, yeah? And then you're looking for a simple entry model, whatever entry model it is that you like. Some guys might like that open high low close of this. Some of you might have waited for, this fair value gap. Some of you on the breaker block. None of you are wrong. None of you are wrong. You see this, right? This is your model. This is your model. And all of you can trade the same model, but your entry upon the model can be different. Some of you like the fair value gap. Some of you like the breaker block. That's totally fine. That's preference. That doesn't mean anything. And this is why I don't like you guys, right, in the Telegram chat saying fair value gap breaker. It's irrelevant. It's so irrelevant. All you're doing is this. You're confusing your peers and yourself. Forget the fair value gap. Forget the breaker block. All you guys need to do is, are you seeing the same model? Or are you seeing the same thing play out? However you want to skin the cat, you skin the cat. Just bear that in mind, right? Just to go over everything again one time. If you can put a full 1% trade on, and manage the risk where your stop losses are being shaved to like 0.5 or under, those 2R trades are going to hit home a lot more because you can take a string of losses if they're managed, right? Imagine you keep taking break even trades, and you hit 3R. You're up 3 odds. All those traders were irrelevant. Now some of you aren't gonna like that because a lot of you are still new and you're gonna think, well, but like, I'm not gonna make that much in the trades. Imagine over 100 trades. Imagine over 100 trades, yeah. If you can manage it like this. Now, of course, sometimes you put a stop loss and it just goes and hits your stop loss. You don't even get time to manage the trade. That's totally fine. That's gonna happen. But I'm saying the ones where it goes your way and you don't manage risk, it is stupid. No two ways about it. You guys need to, especially the ones that are trading. For the guys learning, you're not there yet. That's totally fine. For the guys that are there and you're executing this, start to do this. Like this is how you get longevity and sustainability in your trading. The way and the absolute, in my opinion, and I know I'm rambling on this the last bit, the absolute difference between a good and a great trader is the way that they manage a trade. Because a trader, right, one trader can go into a trade and lose one whole percent. And the trader that took the same trade could have lost nothing, could have even taken a partial out of it. Which one do you think is going to do well over 100 trades, given that they're executing the same exact system? Put it like this, yeah. The last one, I promise. You're executing your system. You and someone is executing the same exact trade. You're taking every single trade, but the one person is managing the trade like how I showed you and shaving off the risk, right? And you're not. Over 100 trades with the same wins and the same stop losses. Who's gonna do better in this system? That's how you guys need to see it, right? So that's going to be it for this one. I'll try to do some more of these, right? It's Ramadan, it's a bit tough for me. This was, something that was, I was able to because a lot of times when I press record, my MacBook is not the newest, so it kind of lags and glitches and not glitches, but it gets slow and it starts to proper like make a big sound. So I'll try and do more if these are helpful. You guys really love these, so yeah, I'll see you guys in the next video. Probably going to be the weekly commentary, or the next lesson perhaps. So until then, and take care of yourselves.